Welcome to the show, and it is a sunny and bright 18th of September. Chris is here looking quizzically at me because maybe it wasn't bright for him.
It wasn't bright when I came in this morning. It was grim. It's warm.
Marching. It is warm. It's muggy.
It's warm, 18 degrees, but it wasn't. I was surprised how dark it was. Sorry, I thought you come into a different city this morning.
Oh, well, I was coming in. It was relative.
Where did you get off? London Bridge?
Yes, London Bridge, but I march across that bridge.
Oh, at Moorgate, it was cloudy and stuff.
Oh, okay. I had a bit of a sunrise, and also I was thinking, this is so nice. This is so nice.
In earlier than you, so clearly.
Indian summer, hopefully.
Indian summer, yes.
Yes, but you're right. It was.
All of 2 days, I think, isn't it? I think today and tomorrow. And that's
Is that it?
Yeah, I think so.
Oh.
And back down again.
Morning, everyone. Donny One saying good post FOMC. Everyone. Shilling. Shilling is also with us this morning, and a person loving that handle of yours. Gavin Ackers, good morning to you as well. And Wing It Maturin. Hola. Steve CDR, morning to you as well. And Derek. Fed dot plots interesting last night. Perhaps a sign of things to come. So we're going to go and look at what's coming up on the show, and then we're going to ask Chris where he was during that speech last night. Here we are. Chris?
We have overnight action with you and me. This is going to be very similar. And then opening bell with you and me. It's exciting. But then it changes. We're going to shake it up a little bit with fast markets at 8:15, where Axel, our technical whiz, joins us to see what he thinks about last night's Fed decision from a technical perspective.
Yes, of course. None of that fundamental business. And then we will have Ron Williams with us on Expert Edge. Also a bit more technical analysis for those of you. So a lot of exciting stuff. He brings his own charts with him too, to give us a different view of what he is expecting, not wanting to...
Very picky about bringing their own charts.
Yes, very picky. And also he's coming earlier to make sure the connections work, because I raved about our new studio. I'll take you through all sessions. Of course, a lot of those now part of the 24-hour offering.
Yes, very good.
IG. Yes, a lot of excitement surrounding that the last few weeks, because a lot of our clients liking the fact that they can trade any time of day. For those of you that don't like sleeping. And then we have man versus machine.
I'll be guesting for Aaron. Now, some might say which one's the man and which is the machine of me and Aaron, I suppose.
You're clearly the machine.
Clearly, I think that's I was going to say that anyway, so you got it. But yes, and then what looks like a late addition to the schedule, as we were talking, live, 9:35. You are joined by a legend, I think it's fair to say, of the city of London, Peter Ambrose. They don't come, the names Ambrose, they don't come bigger than that, do they really?
No, especially not in banking.
No.
And mining.
Yes, and I was reading a book about the Great Depression, and the Hambros crop up in there. So yes, it's a long, storied banking dynasty.
Yes, he's got lots of skeletons and lots of stories as well. Not to mention, one of our very astute viewers asked yesterday, does IG have any idea how big this person is and the person's net worth? And also someone else on our, I'm not making this up because they seem to have cottoned on to the fact when they email ask@ig.com, it all comes to me and I happen to reply. Asking, when is Peter coming back on again? Because they want an update on, that 5,000 target. He said this time next year, we could possibly be at 5,000 for gold.
Yeah, I don't disagree with that. That's not cool.
Speaking of which, there was a synchronized... Where were you during the...
Where was I? Well, of course, you were out and I were out. So I was out as well. So
where were you?
I was at my old school speech day for some reason. I don't know why I got an invite. I wasn't the guest speaker. I don't know why I got an invite, just because I was a guest of the headmaster.
Oh, what did you do? What did you do?
I didn't do anything. I just turned up. We had drinkies in the boardroom.
No, what did you do to garner such favour?
I don't know. No, distinguished city personality. No, not really. And then we had speech day. It wasn't the most interesting speaker in the world about renewable, energy-efficient housing. He works in energy-efficient housing. And it was a bit about this. So he wasn't that fascinating. But it was just nice to go and see the old place again, even though I left some years ago.
Did everything look rather tiny, you get back, it's like everything looks
No, it wasn't primary school. It's not that. All the chairs really small.
yeah, but everything is
No, it has changed a lot since I left, so always nice to go back and see it.
brilliant. Well, I have a special treat for you because Chris
You were
was
out-
invited.
Yes.
You were invited. You snubbed us.
Yes, I wasn't
Snubbed
I didn't snub. I was
Axel
double
and
booked.
myself.
But Axel kindly invited me. Yeah.
Axel was
Where
in
were
true
you?
form. So I was at the STA presentation of the certificates to the new members of the Society of Technical Analysts. In layman's speak, that is those people that survived the 3-hour exam and came out to tell the tale.
Which you did, of course, and passed.
Well, barely. I think I had a flask. Thank you, Monkey Man, for telling me to make sure I had plenty of coffee. Thank you, Rich, as well, that reminded me. He reminded me, make sure you have lots and lots and lots of food next to you because you are not going to be able to leave the desk. And true enough, I did not leave the desk. I used every single minute.
Isn't that the point of an exam? You're not
Exactly.
allowed to leave the desk.
Well, some people finish early, or if you...
I hate people like that.
Yeah, but you can't go, either they failed or they
Yes.
know everything.
Or the people that ask for more paper all the time, and then you think, how much are they writing?
Yes. I'm in the carve out my eraser into a cube and hope for the best. But I couldn't for this level 2 because it was all written. None of it was
not
multiple
multiple choice.
No. And so last night was the presentation. There it is, the certificate. And there we are. Axel was on my right. He delivered a beautiful speech on my left, on the right of the picture. Thank you. I did not have a razzle last night. I have to say I left at 8 p.m. You can ask Axel because I had to be up, bright-eyed,
up and-
bushy-tailed.
Or up at least, anyway.
This morning, and then there we are. I also caught a picture of Axel delivering his speech and welcoming all the new members.
In the august surroundings of the National Liberal Club, isn't it?
Yes, I have not been there before.
No, I haven't. No, I need to go.
It was absolutely stunning. Winston Churchill in the drawing room wouldn't have looked out of place.
No, but then, of course, he left the Liberals, so
Yes, he did leave the Liberals. I was waiting for you to
that's
say
why
that.
he's in the cult and up the road.
Yes, and never to ever appear that side. But, you get the idea, right? Lots of old books, bookcases,
Yes,
leather, on desks.
yes.
What else were?
Very august. Do you spot the Liberal politicians? There aren't many left these days.
Not many left
Davey,
these
no?
days. You're right. No, I didn't spot any politicians. I did cast my eye like a very good analyst into the other rooms. Axel might have thought I was just
Poking around.
yeah, I was actually going to change my shoes, but morning, Pelican, good morning to you, and also Maturin, saying Green Lane Renewables on the charge yesterday, up 30%. I am indeed happy, except I took Wardy's advice, and also, Axel and you talk a lot about this, about risk reward and understanding your risk.
Yeah.
I took out my capital and half my profits.
Right.
So that 30% isn't up as much as if I had left.
No.
But it was a punt. Cow poo is a punt.
You can say that again.
Right, let's go to overnight action. Right, let's have a look first at, the FOMC. What did you think of it?
What did
It
we
was a bit
get?
boring, wasn't it?
It was, and I managed to sit through it without, and I didn't get, none of my positions got stopped out, so I was quite pleased because I wasn't able to check it live. I think you were probably more able to check at 7 o'clock. But the 25 basis point cut probably leans slightly dovish, I think it has to be said. If you look at the dot plot, they're expecting a couple more cuts of 25 basis points this year. Obviously, Stephen Mirren, the outlier on the Fed board, hasn't managed to convince anybody. The new boy. Imagine being the new boy in that meeting.
I know.
Hi, I'm Stephen. I'm here for a short while to do as I'm told.
Yeah, I am. I'm that person
Parachuted
in by the Orange Man.
Yeah.
And I've been hearing about puns over Stephen's surname, which I can't really mention the rest of them. This is from those in the circles that
Those in
go
the
to the presses.
Right.
So it rhymes with siren.
Right.
Myron.
Does it? I thought it was Mirren.
It rhymes with siren.
Okay.
And so no prizes for guessing what else it science rhymes with lots of yes, other things. Thank you, gallery. That's enough. But the interesting thing, the drama was actually more about what was happening behind the scenes. I mean, he didn't stand back and wait a bit. It was like I'm just going to go in and I'm going to do what I'm told. And he did actually waste no time at all with breaking with the majority, suggesting the steeper half-point cut.
Yeah, he did. But as John Author of the Blue Book was saying, it was kind of the dog that didn't bark because nobody else really went with him. You could spot his dot plot right down the bottom. And it wasn't as if there was a sudden caucus of people agreeing with him and saying there should be more. So the worries about Fed independence have been allayed for the time being, I think, because everybody knows that power's going anywhere. There'll be a new person. So I don't think that the Fed board, and maybe they're feeling a bit safer this week now, obviously, since Cook has, the case against Cook seems to have fallen apart, which we'll come to maybe in a minute, because
be a fly on the wall.
The revelations, the fact that Besant used the same process means that they slightly lose their force, shall we say. And this, of course, is a carryover of the guy at the housing agency, Poult, who seems to have probably leaked this about Besant after their falling out a couple of weeks ago. Did you catch this?
Is this about the it became something akin to
a fist fight?
Yes, fist fight. And
harsh words were exchanged now.
And almost came to blows.
Yeah, now I think everybody's team Besant because he always seems to pick on people that nobody likes. Because first it was threatening to punch Musk, and now it's threatening to punch the head of the housing agency. In very fruity language, if you look it up at home, it was reported. We won't repeat it here, but it's a very entertaining story. They had to be sat apart, very far apart at the dinner. So anyway, so the point from this is that the Fed has leaned dovish. In fact, I've written about 4 things this morning, 2 of which say dovish, 2 of which say hawkish. I think that tells you what
you're offsetting yourself.
They've probably sort of hit the right note, I think, and the fact there's a lack of market reaction, I think, is generally good. I think the average reaction on Powell Fed days has been broadly negative. So the fact it held up okay, I think, will please the Fed. So it's good overall, probably good for stocks into the medium term, probably less good for the dollar. Let's put it that way. Doesn't really disrupt the overall narrative. Although we've still got to watch. Inflation seems to be de-emphasised. So that the 2 halves of the mandate, I think the greater weight goes to employment, as you'd expect. And now we wait and see whether the data continues to support that view. Interestingly enough, you get jobless claims today, and they're supposed to be not as bad as last week, because last week's claims were sort of the worry that really showed you that maybe everything was getting weaker. Although I think it was down to some sort of fraud claims in Texas. So even that seems to have been slightly overdone. Anyway, this is where we are with the Fed. 2 more cuts expected by year end.
I mean, you're right. It shows a wide range of opinions about where the rate is headed. I just wish I was there when the first question, apparently, that was thrown at the press briefing, did you hear about this?
No.
Was, so what's with the new guy being a White House lackey, and how can the public trust the Fed is still independent?
That's brilliant. Who asked that?
I don't know. I'd love to find out. It was just like a message that, like, after I left yesterday, all these messages from mates from my past life going, damn, oh my goodness, have you seen this?
That's excellent.
Oh my goodness, yeah. And,
I'm going to look that up now.
Jay Powell, good on him, and looking like he genuinely believes that, the Fed is still going to be, independent, and he says strongly committed to maintaining our independence. But it must, in all things in politics, I'm sure you've covered this enough, your entire life, Chris. Optics matter.
Yes.
Optics do matter.
In fact, they probably matter more than the actual facts of the case.
Exactly. And they must know that this guy, Myron, rhymes with siren, is now teeing up or eyeing a job somewhere in the West Wing after, the Fed, perhaps, or somewhere down the line. So
he's not actually left his job at the White House, has he? Yet.
I don't think he has formally. So in the middle of that, let's have a look at the front page of CNBC. Looking like a slightly positive And I've gone into the European markets a bit, looking like a positive open.
So I'm just reading the FT report on last night. It says Stephen Mirren's dot plot looks like the kid on the playground the other children refuse to play with.
That's a good one. Yeah, so, you know, it'll be an interesting few months, let's put it that way. So after that, we're seeing that, you know, stocks look set to open higher, although not a huge amount higher. It looks like, you know, keep calm and carry on is the mood at the moment. Asia Pacific markets were mixed overnight. The Nikkei rising to a fresh record.
Yes, Japanese stocks on fire as well.
Dearie me, if I had known, I would have put all my money into the Nikkei.
Hindsight is the best trading fund in the world. But yes, stocks were very happy with it. There was a bit of sort of post-meeting wobble, as you'd expect, really, but they've shrugged that off. And so the Dow sitting, I mean, it was a new record high last night for the Dow as well, wasn't it? So very much delivering the goods for investors.
Delivering the goods indeed. And of course, Bank of England is going to announce its rate decision.
Yeah, but nobody cares.
No one cares about that. The main party.
It's supposed to hold rates. But the Bank of Canada cut rates yesterday as well, didn't they? So
No one cared.
Adds to the easing.
Yeah, at the STA, whilst we were waiting for the Axel, if you're listening, we were raptured. We were there watching every word.
You weren't definitely talking amongst yourselves.
We were there going bing, and you could see some people's iPhones vibrating, including mine, iPhones, Apple Watches, and everyone just leant over together, went, oh, 25, 25, and then we went back to listening again. So we were also one eye on the Fed. Speaking of that, what people do care about, or seemingly do care about, because I heard people talking about it on the tube today, is of course Trump on his second day today.
Yes, day 2 of the visit, yes.
You know, lots of the media here in the UK showing jolly pictures between Charlesy and the US president. Notably, not many of him and our politicians, at least not yet.
No, they're all kind of well out of shot, really, as you'd expect, really. He's off to Chequers today, isn't he? Off to the Prime Minister's country house. Not coming into central London, funnily enough.
Yes, strange that, because Axel and I didn't have to weave through quite a number of people who had placards.
Yes, did you?
Outside the National Gallery. So we were a bit worried that there were protests, but we were kind of thinking, he's not in London, is he? So yes, there's the banquet table, and Steve Schwarzman, the CEO of Blackstone, sat next to Starmer, and Tim Cook, Apple's Tim Cook, sat next to Tiffany Trump.
Oh, lucky old Tim Cook. What they chatted about for the entire evening.
Besant flanked the Queen. Or some, yes, the gallery are going to say certain things now, which I will not.
I think they probably said what I've just thought. Yes.
Yes, I also thought, but you know, Rupert Murdoch was there, as was NVIDIA's Jensen Huang. He I would have liked to meet, and Sam Altman of OpenAI and Citigroup's Jane Fraser.
I wonder what the net worth of that table is then.
Probably
Don't say big.
Greater than the entire net worth of the Square Mile.
Well, yeah, yes.
Oh, are you going to use Perplexity?
No, I'm just going to Google the King's net worth is.
Andrew McKelvey coming on saying OM and Zen both raising cash. Bad news for shareholders like me. Look at you. Maturin also chiming in, talking about Halion downgraded by Barclays, but now at a strong level of support. Has it been punished too much? Are you still looking at the net worth?
No, I was looking at the net worth of the King, who's only 640 million, possibly modest compared to those around the table, really, which is a commentary on the state of the world, I suppose, but there we go.
Yeah. One thing that I found quite interesting, the Krispy Kreme rally, the meme. Did you see this?
I confess, no, I'm not up on my meme stocks.
So, yeah, meme stock watch here. This time, what I find most interesting is it's to do with the FBI director.
Right. He looks like a man that really doesn't understand quite what he was getting himself in for, doesn't he? What is it? Who is he? Who is he? I don't know.
Kash Patel.
Yeah. Where's he come
is
from?
The director, FBI of the
Yeah,
FBI.
but where was he before?
I don't know where he was before, but you're right. He's got one of those like memorable type faces.
He looks like a man who doesn't spend his life in a suit most of the time and isn't very used to wearing one. I'm sorry, but it's just the way he looks. Surprised by everything that happens to him every day. I don't really understand. Is he?
Yes, but what I find most interesting, other than how he is dressed as well, is that he was asked to testify before the House Judiciary Committee about his decision to buy individual stocks, including Krispy Kreme and ON Semiconductor. And the FBI director said he thought they were good buys. He said, before I got this job, I was trading stocks, but not a lot like most people. I follow certain industries. Well, stock traders were apparently listening to him because Krispy Kreme shares jumped as much as 11.5% after his comments. The rally was brief, and the shares ended the day higher by around 1%, erasing nearly all of the earlier gains.
Well, I mean, it's not been a great investment, has it? Because it was $20 back in 2021, and now it's $3. So he's not really the next Warren Buffett.
No, but what this illustrates is that there are a load of people out there just listening to people who clearly might not be that au fait in picking stocks and anything, but just listening to what they're saying, and then, they get this outsized move just because of something that was said in a test.
So Krispy Kreme's PR department will be sending him a large consignment.
With
to thank him for sugarcoating their results.
Yeah, thank you on the Krispy.
Yeah, exactly. Yes.
I love how you're always able to put a pun on.
Well, you've been doing this job long enough, you come up, be able to do this kind of thing. Yes. The lowest form of, no, not the lowest form of wit, but one of the lowest forms of wit.
On that note, I'm going to give you some pictures of Krispy Kremes. I don't know about you guys. It's just way too sweet. I get a headache just eating half.
I think so. You can.
So, yeah. So, can we look at the stock? Or I take it Chris hasn't got his computer plugged in.
I thought I did, but my thing next to me has not. I'm just going to tap it, because that might help.
The new studio has
Well, it's not my fault the gallery don't set me up properly, really. They plugged it in, but I'm not quite sure what happens after that, really.
Whilst I'm getting that up, I was going to ask you.
They'll hate me now.
Because there was an even split in the room last night, filled with lots of people from, Mitsuho, technical analysts from even Libram. Then there was people that I'd known for ages from Rathbones. And there was an even split people between whether or not quadruple witching is going to be something that will rock the markets this Friday, and the other half of the room saying, actually, I don't think it's going to. Which side of the camp do you sit on?
Oh, well, it's the kind of thing that you only really know after the fact, because there are some weeks when it does matter, other weeks, other months where it doesn't, I think is the key to understand that, really. This idea that it imparts a major direction in the market, most of the time it isn't, really, I think. If you're very, very short term, you might certainly see some volatility. If you're looking at the 5-minute charts, yes, you get a bit of volatility around it. But if you're looking at this long-term move, the potential is less, I think, for anything particularly big. I think the key thing to note is that you've had a Fed meeting, you've had a big rally, even since August. We're up sort of 2,000 points on the, not quite 2,000 points on the NASDAQ 100. And so there is a lot of good news currently priced in. And that said,
it's priced to perfection. Is that what you're trying to say?
No, I wouldn't say. I don't like that phrase, because that phrase has been trotted out repeatedly over the last year and it just keeps going up. I think it's more noting that we've come so far in a short space of time. You are in the window of sort of late September, early October weakness. So if it was going to kick off, now would be the time. It wouldn't be surprising that you get a Fed cutting rates and everyone says that's good for markets. There's the gallery laughing at me. I can tell, Yes. I can tell. This is why I've not got an earpiece, so I can't hear what they're screaming at me. Anyway, I think if you do get some weakness, it wouldn't be surprising to see it here, I think. So this is the key thing to watch in the short term.
The amount of green bars. This is the 15-minute chart, friends, but also taking a look at the daily as well, because take a look at that 1, 2, 3, 4, 5, 6, 7, 8, 9. I mean, you can see.
I think that's a record. I think that's a record for advances. To just go up and up and up.
Is it in the record?
I think so. Yes, I will need to check, but I think the data bods on social media were saying that yes, it's one of the strongest rallies for the Nasdaq, certainly in a very long time.
Yeah, and what's fascinating as well is if I go to the weekly chart, you can see a bit better here that just be aware that volume is petering off there. This is the weekly chart.
See, that's the thing that gets me. People say this about rallies, that you shouldn't trust a rally where the volume is declining. I think it doesn't really matter.
Oh, interesting. Tell us.
Because in rising markets, people tend to do less, I think, and you have people that mostly tend to hold on. So you tend to see the volume decline anyway. The volume then tends to rise as it becomes more volatile because people are doing more, perhaps selling more. So there's a lot of people who will say, oh, you have to be concerned about a rally that has volume declining. But the fact is about this rally since April that it's one of the most hated you've seen because everyone says it shouldn't keep going. Even when I came back from holiday in September, there were several people within minutes of me arriving in the office saying, oh, but it's time to drop a bit, isn't it, really? And look where we are. The Nasdaq has rallied 10 days in a row. Markets don't do what people want them to do, I think. And the fact that people still say, oh, it's due a pullback. Well, yes, it probably is on the law of averages, but that doesn't make it go down. We do need a catalyst. I can't tell you what that catalyst is. Maybe the catalyst is the Fed cutting rates, ironically, but it needs something. At the moment, that hasn't appeared, really. And the fact that the rally's broadening out with the Nikkei at record highs, Chinese stocks at 4-year highs, shows you the strength in this bounce.
The only consistency here is markets tend to do what you don't want it to do. Yeah. It is great, teacher. I hear a poll there, so let us know. We'll have guess the chart first, but I'm going to type the poll out to you, Phil. Do you pull back or change your trading or investing portfolio when you see a drop in volume? We'd like to know. Right, we got guess the chart.
Mm-hmm. Well, where is it from?
UK. Where is it?
Oh, that narrows it down.
Phil, do we have a sector even? Oh,
well, don't narrow it down too much. That takes
okay, so UK. Here we go. What do you think the genre of music is going to be? Come on.
I'm waiting for something good. That's what I'm waiting for.
I quite like the hoedown. I quite like a country.
I've not heard the hoedown one.
Oh, there's a tango one as well. Right, here we go. Guess the chart.
The chart, she whispers. But does she tell the truth?
Step by step, I trace your line. A flicker red, a candle fine. You lead me up, you pull me down. You wear a bull's face, then turn around. Guess the chart, mi amor. Is it pain or is it profit I'm dancing for? With every tick I lose control. Your side raised glance devours my soul. Producer Phil plays coy. He shrugs while Rich is hedging all his plugs. But Ange, she sees, she knows the game. She whispered short, then lit the flame. A wick, a gap, a silent fall, a fib retracement, or none at all. The RSI is on the brink, but I can't move. I dare
Right, we're counting down to the opening bell. We'll announce the chart later. Lots of good guesses there. 3, 2, 1. Beat your head.
This is the bell.
This is the bell.
Right.
It was much louder. Thank you, whoever sent it to us from Nottingham. But it was starting to burst the eardrums of the gallery people.
Someone's
so that's why.
muffled it.
With gaffer tape. Speaking of which, it is. What is not muffled are the markets. We are
Oh, seamless transition. Very good.
riding higher there, and it's looking all blue at the moment, or green if you're using another platform there. But we are seeing Europe really coming off the mark pretty strong there. Germany up 0.75%, FTSE up 1/4. Let's have a look at the biggest movers here. FTSE first, winners. Chris, any of those jump out at you?
Well, it was bereft of news apart from Next this morning. So I didn't actually see Next not in the top risers yet. But Relx, nearly 2% up. I haven't seen why. So I need to look up. I didn't see an upgrade for that. But Rolls-Royce, I can't say motoring ahead, can I? They're flying high. No, I can't because it's not the cars. But yes, moving high, 1.5%. Engine, same thing really. 3R Group at 1.3%. And then Whitbread, interestingly enough. So it's a few interesting names. Defence as well. BAE joining in. BP as well. And Barclays. All the Bs this morning. All the Bs moving higher.
All the Bs. Let's have a look at the losers list there. House Builders, Barrett Redrow down 0.75%. Centrica also down 1.2% there. Fresnillo down almost.
Having a bit of a knock because one of the best it was the best performer, the FTSE 100 this year, and it probably still is, given the way silver's performed. So not surprised to see it come off a little bit. But if you were missing out on the Fresnillo rally, maybe that's your chance to keep it on your watch list to buy the dip, perhaps. And then Sainsbury's off by 1% as well. So a little bit of a gloomier morning for UK stocks overall.
Yeah, let's have a look across to Germany, the Germans.
Are you required to do that? Because Rich does that as well.
No, I'm not required to do that. I'm saying it just because Infineon Technology. I had to think about something else to say because
Well, say it in German.
well, when I was here, the producer Fred was here,
Yes.
and he didn't like anything pronounced in French,
No, I can imagine.
and then it just made Rich say more things in French.
Yes, yes, I could also imagine that.
Just you saw my cheeky smile earlier. That was me saying no to Phil. Which caused a lot of consternation in the gallery. Infineon Technologies up 2% there. Siemens up 1% as well. Heidelberg Materials up more than 1%. Banks, Deutsche Bank.
Commerz and Deutsche. Commerzbank was Axel Rudolph's old shop. Of course, where he didn't join us from Commerzbank. Or did he? I think he did.
I think he did.
Yes, he did. Yes.
Yeah.
Long-standing employee of the company. Anyway, that's by the by.
Reinsurers also higher there. Munich Re. Let's take a look at the losers for you. Seeing Volkswagen down just 0.25% there. Henkel, another defensive, also down by 0.1%. Continental down 23%. What's going on there at Continental? Do you know?
Deflating, really. No, I need to look at that because interesting. The DAX overall is up nearly 0.8% in early trading, which is interesting because we hit a 4-month low this week. Down towards 23,300, seems to be recovering. So it's been a poor couple of months for the DAX. Although if you look at seasonality, as you know, I'm obsessed with seasonality. Actually, it's the best period for the DAX starts almost now. I think the 1st of October is usually the very strong performance for them. But next, still
we need
waiting for some data on next.
Waiting for to uncross. We'll keep an eye on that one for you. Phil, Terence and Cam, if you can keep an eye on that one because Next was very cautious on its second half trading outlook. Thanks so much, Phil. Also looking at France now. Let's go over to France. We've got Legrand at the top of the winners list, so Legrand. ST Micro 1.7% higher there. Chris?
Still a few defence names as well, Dussel, in there coming up. And Thales, BNP as well. So better morning for banks. I imagine the
charitable interpretation would be, I suppose, if the Fed is cutting rates, good for the US economy, good for everyone else, really. And of course, the French stocks, absolutely stormy performance since the no confidence vote. So once again, in the annals of markets, political turmoil has proven to be a good moment for those looking for an entry point in markets, because there was all this bearishness about France and it was on the point of collapse. And of course, it doesn't happen. And then the market rallies. And very much the CAC having outperformed the DAX over the last couple of weeks, the French leaving the Germans far behind, which is an interesting turnaround, really.
It's also interesting to see that we've got quite a few industrial names much higher as well. Thales recovering some composure after overall they did have a good week in the DSEI, the Defence Summit last week. But prior to that, defence stocks have been paying. Nexus Open, I'm hearing down 5.5% there.
Ooh.
Let's have a look. 5.8% down. Look at that move.
But is it gone? Is it ex-div today?
Or is it because of the outlook? Have a look. Because it did say that it was cautious on its second half trading. Can I just say that next, I know that they stole the march when they came out with their, what is it, that book that everyone had? I seem to recall it. It's behind people's sofas at one point, wondering what on earth that thing was, and then seamlessly stealing the march and going online.
Well, yes.
But I often wonder, you know, how is Next able to keep going with the likes of ASOS? Is that how you say it?
Well, yes, but it's seen off ASOS entirely. ASOS is now the fallen angel, isn't it, really? And Next was a record high at 13 a share back in May. So just take a bit of a knock. Now, this is classic Next, of course, because every time they report, they say, in the guidance, it says, oh, the next 6 months, next year might not be quite so good. And the shares do drop often. And then the next report comes around, they say, oh, actually, we did really well, and we did better than we thought. And then the shares rally. And they do this every time. Everyone seems to fall for it every time, and it works for them. And that's why the shares have done really, really well. But if you look at that, it's a classic example of long-term investing, because you had to hold Next all the way through from the highs of 2015 and just essentially not going anywhere. Now, there's a trading range for you, if ever there was one, of what, 6-7 years. So there's patience for you. You're still getting your dividend. You're still getting your long-term view. But obviously the shares themselves, where everything else is continuing to rally, are being left behind, probably because it's a UK stock. So even a quality company like Next just gets left out. And then suddenly, for whatever reason, it finally begins to break to the upside, and you get the breakout, and it delivers to fresh record highs and indeed triples in the space of 2 years.
Absolutely. And also, if you didn't want to have that long-term hold, you could use technicals by having a line to draw where it's never ever a line, as you hear Axel say very often. It's an area of interest.
Yes, it's very, very wise. Yes, because people draw lines and it gives you that false sense of security that it must hit that line. If it doesn't hit the line, it isn't relevant. No, I think it's an area of interest. Also, if you want to wind Axel up, start putting very thick lines on your charts, because that will annoy him considerably. Do you do that on purpose? No, but I do flag it when I see it, and I send it to him, because I know it's better to sort of poke the bear a bit, because it's good to.
You love that, don't you?
It's good to wind up technical analysts.
We do, yeah. That's why Chris comes over every so often and drops
just to stir the pot.
Drops a T next to me. He knows it's quite easy with me. Drops a T or an F on purpose. But taking a look at this, if you wanted to look at this from a technical viewpoint and time your entry, you would look at a firm close above that area of interest that I've drawn for you. And also you could use your moving averages. I quite like this as well. So putting your moving average there. And can you see that it coincides? If you have a close above and consistently price action is above the area of interest, and it coincides with good volume, and also the fact that price action is happily above your moving averages.
Yes,
all three.
A good sign, of course. That's the kind of thing. The indicators, I think, should reinforce what the price is telling you anyway. They're not a substitute for the price itself. This is how I was always taught to view it.
Yeah, and I always look at what's supporting the data. I'm going to try and poke Axel here too, because numbers can lie, as we know.
Well, I suppose so, yes. And
They can.
If you want to view it, whenever someone asks me about a stock, someone says to me, what do you think of XYZ? I will always look at the chart first and say, is it going up? Is it going down? Is it going sideways? What's the market telling you about this stock? Which is why people, I think, find charts so useful, because you can get an at-a-glance view. Do people like this stock? Do people not like this stock? Okay, you do get stars that have periods of underperformance. The stocks haven't been recognised, but often, the reason why NVIDIA goes up so much is because people like it because it's delivering the goods, and so you get a sense from the chart just by looking at it very quickly what the market's view on it is.
Just very quickly, we're going to go to good chart, but I'm just pointing out that if you were looking for a bittersweet stock, you like chocolate?
We're good.
Barry Kayabu shares down 4% after Deutsche Bank.
How is it pronounced?
Barry Kayabu?
Okay, I didn't know. I wasn't trying to catch you out there.
I'm only repeating what I heard at a chocolate investing conference.
You go to all the fun places, don't you?
Thank you, Schroders.
But you didn't bring any chocolates back, I noticed.
This wasn't last night. This was a while ago when they were really pushing their commodities desk.
Okay.
So I learned a great deal about cocoa. and the CEO as well saying that the debt of the company has to come down. So if you like all that you've heard and the great moves that we're giving you, do hit the like and subscribe button, and also make sure that you don't just listen. We know that 50% of you there that are just listening. Don't do that, because it means that we can't bring you more of this good stuff. And guests, we've got Ron Williams coming up, and also Rich is having a well-deserved break because he's getting ready for the next Art of Investing podcast, which is being recorded today. Ashton17, welcome to the show. Just join. Any views in Puma will be, and Adidas will be sorted later on. But first, let's have the winner of Guess the Chart.
Oh yeah, I forgot. What is it?
Ah.
Okay, not WH Smith's, of course.
That.
Smith's Group, not the same thing.
Julian has won. Well done, Julian. I was flummoxed.
I was flummoxed, actually.
Let's have a quick look here. Yeah, Smiths. Here we are. Very quickly, Smiths Group.
Engineering, of course. Okay.
And so, yeah, it's...
wow, they've done really well.
I like this chart. Very strong moves there recently, and also it obeys that upward momentum. It's left my moving averages on.
Yeah. I always say stuff that is going up tends to keep going up, and vice versa. I think
Don't try and fight it.
Nope.
Or guess,
Don't try and call turns. It's very dangerous. People love to do it. It's very dangerous.
And on that note, we've got Axel coming up.
It just sort of flows, doesn't it?
It flows. So wonderful. And like seamless, like a Burberry trench coat.
Yes. Are they seamless? I've never
Which
had
I don't own, by the way. Own the shares, not the trench coat.
There you go. There's viewers can send in a Burberry trench coat. Yeah.
Right, and so hold on to your hats because we have Axel flying in soon.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Oh, yeah. Hey guys, where are you going? You're not going to get better than cash returns.
Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hello everybody, welcome back to Fast Markets. Angeline has disappeared for coffee, so you are joined, I am joined, I should say, by Axel Rudolph, fresh from the celebrations at the STA do last night. Did you have a good time, Axel?
We did indeed, yes. Society of Technical Analysts annual do at the National Liberal Club. Always very nice to be there. And no, it was lovely. Plus, the weather wasn't actually as bad as I thought it was going to be. So we spent the rest of the evening on the terrace overlooking the Thames. So it was
very
lovely.
civilised.
So,
very civilised. Yeah. Super. So we have, what have we got this morning? What's moving this morning have we got? We've got Morgan Stanley cutting house builders. Maybe can we start with them? Do you think? Should we do that? Barrett Redrow.
Let's do that, yeah.
Cut down from 560 to 510. Persimmon, Taylor Wimpey and Vistry all reduced. So if I just get them up on my screen in a second.
I mean, the problem with house builders in the UK has been that over the last few years, they haven't really done that well if you compare them to other FTSE 100 charts. And obviously, the reforms that Labour is trying to put in place in order to build more houses aren't happening at the speed probably the house builders would want them to happen. And that plus, in general, also still the backlog of supply disruptions that we had after COVID and things like that have negatively impact house builders. As you can see here on this Barrett's chart, I mean, it's not looking good, is it?
No, and this is what we were saying before the break about you can look at a chart and you can all see what the market thinks about it, can't you? And I think this is the market is sending you a message about Barrett that you've had 2 years of rally for a broader stock market, and yet here we are with Barrett that it's recently hit that low, is the lowest level since 2022. So another poor, very, very disappointing performance, isn't it, from Barrett? I think. What would you tell me about this chart, Axel? You're the expert.
Well, it's trying to bounce back, but the problem is it often looks as if it's trying to bounce back. If you go back to previous months, etc., where you were just now, you see these movements up, and then you see another leg down, movements up, and another leg down. So what we're seeing at the moment might just be one of those. Plus, if you look at the 400 area, just below there, we've got all these 3 lows going back to earlier this year, and then also last year. You've got a lot of resistance. So I'd be very surprised if Barrett Redrow were to, even if it were to rise further, that share price, if it's going anywhere. If you want to read more about it, I wrote an article about the company, I think last week or this week. Just look at, or just go IG, Google it, IG, Barrett Redrow, and you'll find it. So you can have a fundamental and a technical view on this share. But yes, house builders in general in the UK haven't done that well over the last few years.
Yeah, we had Barrett and Galliford Try reporting numbers on Tuesday, didn't we, I think?
Yes.
Not particularly well received if you're looking at this chart. SIG Group is the next one. To throw a random name at you, actually, on the back of that. Angeline tells me it's moving.
Right.
I can find it. There we go. SIG.
Well, it's the same thing. It hasn't been done. It hasn't been doing very well, as you can see. A very, very clearly defined downtrend. Bad
performer, isn't it?
Yeah, and the problem is people when they buy stocks like this, basically they're trying to buy because they think it's cheap. Oh, it's going to go back up again. Well, it can go lower than you think, and it can keep on going lower than you think, and then you get these movements where it goes up a little bit, and you think, oh, it could actually go higher. So you don't want to get out of your stock, which has been underperforming. And you keep buying more, for example, and then it just goes down again. So that's not the right way, as we always say, Chris, to do things. It's better to buy something, even if it's making an all-time high, even if most people are scared to buy there, because the odds are that trend is going to continue and make new record highs. With this stock, it's the opposite. It's more likely to hit its record lows and just continue to go down again. So next is a different story, though.
Yeah.
Next, as you've just mentioned, really interesting, because every time before earnings, their share price tends to go down, and then afterwards they beat expectations, goes back up, and as you said. And here we could see exactly the same thing happening. I mean, Next is in a very nice uptrend and has been for quite a few months now.
Yeah, and this is the weekly chart, of course. I think it's a case of, and people talk about this. I don't know how much store you put by, Axel, but they're talking about the sort of distance you get between the price and a moving average. It's often a sort of sign of caution. I think it's sort of, if there's all this white space between one and the other, you often think, well, at some point that has to close. You often see that sort of distance or that gap close, don't you?
You do, yes, and technical analysts can use that as an indication of a stock market having moved too far away from the moving average and therefore likely to mean revert, which is happening here. But what is also interesting on this chart, if you see the spike high on the left, that's where our support is, just there exactly. So we are close on the weekly chart, so it's a pretty important support. So I wouldn't be surprised if we were to hold here in the next few days. The only worry I have is that the current weekly candle to the downside is obviously quite a long one, and that is not positive. It's not like the long candle we saw a few weeks ago beginning this big up move to the new highs. So we'll need to watch this one and to see whether that support's going to hold. It's not because it's a support that is there that it is going to hold. If you have a lot of momentum behind a down move, that support may be breached, in which case the next share price may go back to where it was sideways trading for several months previously this year. But yeah, it's interesting to see what's going to happen to the share price in the next few days. Obviously, today wasn't great. We've come off. But we've got this 200-day simple moving average here also coming in as support. So we'll see whether we can hold here or not, and then gradually build up again or not.
So we also had Puma was the request from in the chat, because there was speculation on Adidas picking up the stock as an acquisition. So there's another one. Oh, it's a bit of a similar story there in terms of a downtrend, isn't it?
Yeah, and that's probably why we've seen that spike high on the right-hand side of the chart. But as you see, we're still in very much bearish territory. Wow. Yeah, exactly. Wow. I mean, it's not done well, and a lot of people have kept their holdings of Puma, thinking, oh no, it's gonna come back, and every time it does go up a bit, it keeps going lower.
Well, you get these false dawns, don't you? You get this rally in early 23 that happened, and you think, oh, August 23, it's going to bounce. And repeatedly, what you think is the beginning of something is actually just the continuation of what we had before, really.
Yeah. And if you were a technical analyst, what you would have done here is just looked at that highs, and each of these bounces, even though they're quite significant at times, were lower than the previous one. So your trend was still intact. You still had a series of lower highs and lower lows. So there is actually no reason to go long.
Yeah.
But yeah, I mean, now obviously at this share price level, it might be a very interesting takeover target. And yes, Adidas may purchase the company.
Yeah, and lots of much cheaper than they could have got it. Nasdaq, of course, let's talk about last night's Fed-induced madness, where we had the brief drop for the index below 24,000, and then almost immediately, I mean, if we do the intraday chart, you can see that there, and then almost immediately back again, which you'd expect on Fed day, really, wouldn't you? I think the volatility is kind of a given.
Could you go onto a 5-minute chart, please, Chris? Because what's really interesting there is that I never trade around, you know, these sort of announcements, because the volatilities, if you go further to left, I think it's just crazy. Can you see this bit there? Sort of up, down, up, and then sideways does nothing, and then the trend gradually goes higher. But yes, I mean, you have to have such wide stops. You might just get stopped out at the high or at the low, and you might have even been right on your view, but gotten stopped out because of the volatility. So I would strongly suggest around those times of, you know, BOE press conference, maybe less so, but ECB definitely press conference, the Fed even more, announcement and then press conference afterwards. Just wait, because when the trend establishes itself, you've got time to then slowly get into it, and it will just, you know, still perform, but you're not going to have this high volatility move that might just whipsaw you all the time before you actually get it right.
And then, of course, if you go out to a higher time frame, even the 4 hourlies, the move is minuscule by comparison, isn't it, really? And
exactly. And you already had a very nice trend in place. And if we go back to the daily chart, I mean, it's unbelievable. I know we both don't agree on what's happening next. And so far, Chris, you've definitely been right. I mean, this is just unbelievable.
I'll get that bit clipped out by the gallery. I think that would be good. It continues to rally. Yeah.
Yeah, can you see all these green candles on the right-hand side? If you just zoom into those, I mean, I don't know how many we've had now.
I think it was 10 as of yesterday, which I think we're saying is a record.
It is a record. It's crazy, but it is what it is. Markets that have a lot of momentum behind them keep going in that direction. In this case, it's up.
And the fact you had that brief dip and then immediately it gets seized on by weakness, I think, at least in the short term, sends you a message, doesn't it, really, that there's enough buying power behind this move to keep going in the short term, at least. Clearly, we don't know what happens next, but you've got, if you look at seasonality, roughly now is when it should come off if September was any guide. Although September as a whole tends to be weak, and it hasn't. It was clearly outperformed your average September so far for the Nasdaq. And then obviously you get Q4 is very strong. So it's definitely one to watch, really, I think. And then we had a couple of requests as well, just to chuck these at you. D-Wave Quantum, I'm going to have to look this one up and hope I find it on the chart. Hang on.
Whilst you do that, I just want to mention that the Nasdaq is going higher. US markets in general making new record highs, but they might be doing it at the detriment of European markets. I mean, I know the DAX is back up again, but over the last few weeks, what we've seen, as you mentioned before, is the DAX and the CAC coming off, the CACs then rallying after the political turmoil there. But basically, I think we continue to see a rotation out of European stocks back into US tech stocks. And that's also why yesterday the Nasdaq rallied quite strongly.
Yes, of course, was the comment from Bank of America earlier week. The fund manager survey came out and you showed the biggest drop in UK stock allocations month on month. So it's a limited view, but the biggest drop in allocation to UK equities for at least about, was it 15 years, I think it was. Having said that, you'd had the biggest move into UK stocks on a month-on-month basis in January. So these things tend to balance out. But it was interesting to note that maybe we are seeing, from being sort of out of the US in April and May, it's now reversed because obviously the tariff fear is reduced. You've got the Fed cutting rates. It's enough to look at. So just one more to throw at you. D-Wave Quantum, a request there from the crew watching at home.
So I don't know anything about this stock, but all I can tell you is that the share price is looking pretty impressive because we've broken through these previous highs here, and we've just had this huge Marubozu pattern here, this big green candle on the right-hand side. And Yeah, I mean, it just on the weekly chart looks extremely bullish. Can you go onto the monthly chart, please? I don't even know whether that's an all-time high or not.
I think it is.
But it looks like it.
Certainly as far as our data goes back, yeah.
Yeah. So strength, thank you, Chris, begins strength. I mean, this stock is running. I wouldn't get out of it for now because it can go quite a lot higher.
There you go. It's an interesting performance there. It must be something tech, surely, with a name like D-Wave Quantum. There's got to be something tech related in that, the way that's moving. Good. And I think that's all we have from that one. So thank you very much, everybody. We'll be back in a couple of minutes with I forgot what it is. Ron, William and Angeline will be back again. Thank you.
Thank you. Bye.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Welcome back, and we have a special treat for you, a brand new guest, but one that is very familiar with the markets and widely known in the world of technical analysis. Ron Williams, welcome! Oh my goodness!
Great to be back.
He's also CFT, and he was at the event last night.
Yes, I was at the STA annual gala event.
I left left at 8. What time did you leave?
Shortly afterwards, after a busy work trip, I've decided to head back home and be ready for our session today.
Oh, fantastic. Well, I've primed everyone, told them that you were coming. So give us a quick introduction. Tell everyone, you know, your history, what you've done so far, what you're going to... He does a lot of travel, by the way, so it was very difficult to align our diaries.
All good and happy we could make it work. Basically, my focus is markets and mind, so it's a blend of the two. So markets in terms of market strategies, I've been doing that for 25 odd years, working with leading institutions, now run my own investment advisory research firm, and there's a consultancy part of that focuses on education training. The second part is, of course, the mindset, market and mind, and that's the realization that about 80% of what we do is all to do with subconscious behavioral patterns, and that in order to be successful at trading, we need to manage and raise awareness and then manage and optimize these patterns in a way that can be conducive to good trading. So I focus on both personally and with students and clients. And on the market analysis side, in brief, macro, tactical with a behavioral lens driven by cycles.
Nice. For those of you wanting to search for his work, just look up Ron William. And as a special favor to me, as I've known you for such a long time, I specifically asked Ron if you could bring in some of your special charts for us.
Yes, picture speaks 1,000 words. And I really think in charts, so hopefully that'll help with the visual engagement for the audience.
Nice. I like this one with the bull. Like, talk us through this.
Well, the headline theme is an emboldened bull still dancing on the edge. This is in terms of risk appetite that we saw first half of this year post shakeout. And credit to Hedgeye who drew the cartoon on a month-on-month basis. I look for these behavioral pictures that best capture the zeitgeist of the moment. It's a way of thinking laterally, having our biases in check, but then also understanding what the underlying themes might be. So this shows the bull is strong, yes, but it has been climbing a wall of worry, and it's been juggling live bombs during that process. So it is a face value positive sign of resilience, but at some point instability does show up, and you can see I've just labeled some of the live bombs: tariffs, geopolitics, and ultimately cycles. These are things that will continue to stay with us for a little bit longer.
Nice. So let's move on to the next page here, because I love it that you've got yellow for gold, because I use that for my lines in charting.
Very good. It's intuitive.
It is. It's very easy to spot when you've got slight astigmatism.
Yes.
Yeah, but I just use it across the board, not just gold, but other financial instruments too.
Well, a cultural point I do want to make, red and green is not universal.
No, it's not.
Having lived in Asia and worked there for some years, I learned that pretty quickly. So red is good.
Yes, red is very good in Asia. And also
prosperous.
some parts of Asia, like Japan, they have their red and greens in reverse.
Yes.
So red is actually up. You're having an up day if it's red, right? Gains are red, and green's not good.
So it's good to know that, I mean, based on the world audience that we're in, but also a personal choice depending on what stimulates your line of thinking when looking at these colors. Here, it's general colors, intuitive where possible in terms of gold, but you'll see light blue is Europe, shades of blue is so equities, I should say. Pink is treasuries, Asia is in shades of green. So there is some sense to at least regional geography and asset class. That's the general mix. But what we're looking at is trends over time in its purest, simplest form. Long-term, strategic, tactical, medium-term, and active short-term. For people that like to know the data that's driving this, think of annual, quarterly, and monthly as your general time durations for these trends. And the whole point of this is if the trends across these time frames are consistently up or down, then it's a resilient trend, and one that is best to back, either long or short. Here and now what we see is digital assets. Ethereum basically was leading, now potentially giving us an early unwind signal. Crypto acting as a risk-off potential, but Ethereum also outperforming Bitcoin for other reasons.
It has been for some time.
It has been for some time, and our main feature chart is of Ethereum as well. And look, switching from digital assets to equities, Japan and China outperforming the US, both at all-time highs. China's unwound a little bit, but with a very different valuation gap. And various other factors that are making it more attractive at the moment. So that shows a little bit of global divergence taking place and rotation. Gold doing what gold has been doing for some time. The long-term trend remains strong, resumed higher, fueled by haven flows, but also resumption in inflation expectations with a broader commodity uptick. And that's the key thematic insight from this ranking model.
Nice. Talk us through duration, and you've labeled it strategic, tactical, and active. So talk us through duration.
Yes. So the key thing is to look for the outlier trends, up or down. But it's also important to look at rotation, and that is what we're seeing. Gold at the moment is in the strongest ranking trend, and it's consistent across the board. You can see it's a straight line across. Whereas Ethereum is strong on the left, which is the long-term annual trend, but has recently unwound, having broken above the 4K level. We'll see that shortly. And you can see it's outperformed Bitcoin. Bitcoin should be there further down lower. For those who can see the detail behind. Interestingly, USA, it's the market that we know so well and love in terms of price action liquidity. It's strong, but it is losing some momentum, and that is during this seasonality, typical volatile period of September and October. So a healthy unwind likely, especially for those markets that have moved the most and are overvalued.
Cool. So let's make this useful for, this is very useful, even more useful for our viewers. So let's say, we're looking at this and someone's in Ethereum, and we can see that it's on the strongest, right, on the left-hand side, but it's moved down to tactical, and then it's also moved down the list in Ethereum. What exactly should we take from this? Is it basically, in 50 in a quarter, in 3 months' time, perhaps you might want to reduce your holdings. In a year's time, if it moves further down and it moves into the active, but down towards neutral, should you then change it up so that you have even less exposure? I mean, how does it work?
So the best trends to back are the ones that are the strongest. And on this ranking model, it's strong or strongest. If you wanted to get an early signal, strong is your earliest, not before. We've backtested this many times over, including my mentor, Robin Griffiths, who originally designed the model 50 years ago.
Oh, wow.
And we've evolved it over time to include global, cross-asset. It works because it's simple and it's effective. And when we over-optimize, it works less effectively. But what we have realized is the best trends to back are once they emerge into strong and then strongest. The times to let go of those strong trends, because a trend remains your friend until signs of reversal emerge. I remind clients and students of that on a regular basis. That needs to confirm and follow through. But one of the signals on this model is a rotation out of strongest into weakest. So we typically look at the outliers, strongest and weakest, to see where the best and worst trends are currently, but also where they may progress. Now, your great question as to strategy and tactical really depends on who is in the market. If it's a long-term strategic investor versus a short-term tactical trader, based on their objectives, their strategies, risk, money management, and all the rest of it. But the best way to visually explain that point is the chart on the top right, which gives you an idea of the ripple effect. And you can see the big blue line giving you that long tidal wave move. But along the way, you get zigzags that take place throughout the market. How investors and traders take advantage of that ripple effect is down to their strategy and down to their objective at the time. So a tactical will look for short-term, swing opportunities up or down, depending if they want to take a long or short bias. And a long-term will buy and hold. Gold is a great example of buy and hold and buy on the dip. Ethereum, buy and hold because it's just been so strong and reflects the altcoin rotation. But perhaps lighten up now or wait to load up some more if it were to break up higher.
I'm interested, very interested in this wave because, what does your trend cycle model tell us about tech stocks? We have a huge number of clients that have positions in tech stocks. Of course, we've seen all indices in the US, keep climbing and climbing, despite almost ignoring any of the warning signals from the bond markets. And everyone's wondering, have tech stocks got too high, too soon, too fast? And where is this summer correction? So do you have any insight using this trend cycle model to do with tech specifically?
Happy to revert back to the question on the chart on the S&P 500, because that gives more hard and fast tangible signals as to what to expect next. Also, I say that given that the market has surprised so many times to the upside, so it is best to wait for real confirmation of momentum exhaustion, reversal and follow through. Otherwise, as is often the case, we're waiting for something to happen which hasn't happened yet, and then of course the market catches us out. So with tech in particular, the story has been phenomenal for the long term in terms of innovation, in terms of valuation, but momentum has been strong and yet continued. Concentration risk has been super strong at record highs and yet continued. So it's one of those runaway train trades, which is great when you're long and making money, but requires caution when we're calling an unwind.
That's brilliant. That's why we've got these wonderful charts coming up. So this, effectively, I like to call this like a heads-up display. Talk us through the charts here. I love that you've used perforated lines as well, because I do use that in bright yellow, because it kind of gives me a heads-up display as to where the next resistance points are.
Yes, and with dealing with crypto, big round numbers, but also a lot of volatility, 20% average per day. Ethereum has just really shot up in general as an alt digital asset leader, but also reversed Bitcoin's cross-crypto performance. And you can see the Ethereum on the main chart left, breaking above 4K, and now range-bound between the next glass ceiling of 5K, but still holding 4. The averages are there just to give trend analysis, but also trend support. So you can see the 50-day quarterly average, as we were looking at in the model, is reflected on the chart. So we can see it in action. That is support at 4,288. And the long-term 200-day annual average is at 2830, a long way from where we are at the moment. But the 4K mark is support. The chart on the right shows Ethereum versus Bitcoin. So again, it's the big story is not just Ethereum shooting to the moon. It's Ethereum's relative outperformance across the board, especially Bitcoin. And we can see the reversal there of Bitcoin's kind of poster child outperformance.
Do we know how long this outperformance will last?
For a while longer, according to our analysis at RWA, based on just the trend analysis itself, but also Ethereum's story is partly built on the stablecoin enhancement of this year, which received more government support. Ethereum's the actually technology that is used for that. So there's some fundamental drivers which will likely make Ethereum stronger ahead.
There's a lot of mood music surrounding regulatory breakthrough in that space where soon governments might allow crypto to be, put in wrappers, if you like ISAs and things like that. You positive? You feeling positive about this becoming a reality, or are you still skeptical?
Positive institutional flow is strong and hitting extremes, including Ethereum, and on the back of regulatory breakthroughs that you mentioned, and ultimately government support, specifically in the US as a case example, stablecoin and Ethereum benefiting from the technology side. It also allows more economic adoption, which maybe curtails a little bit of the rife speculation, which I think has been some of the concern since crypto's inception. We've moved on since then, but clearly it's going to be a relative game in terms of which cryptos win out and fulfill the needs of the market, and that'll be what most digital asset followers will continue to track.
Mm-hmm. Great. We have a question from Andrew McKelvey, which we can get to in a bit. Can Ron talk about gold, please?
Yes.
I know you got S&P first. S&P, let's have a quick look.
Yeah, S&P strong, but losing signs emerging of a loss of upside momentum. Remember, this is a market that rose from the ashes of the spring shakeout of earlier this year. Most people are in amnesia state. We've forgotten that there was a shakeout, 10% in a day or two.
How soon we forget? I did not forget.
Well, ultimately, we're governed by greed and fear, and when greed takes over, our eyes focus on that. And ultimately, the trend did recover back to all-time highs. But I think more than that, it's not just a surface value market recovery, it's the fact that we recovered so quickly, but also despite so many different uncertainties, headline spinners in terms of what next. And this wall of worry really came into fruition this year. If ever there was a climbing of the wall of worry, Wall Street acronym playing out, it was 2025 first half. The issue now is that we think that the market climbs that wall of worry forever. And the answer is, lines don't move up in a straight line forever.
Yeah, trees don't grow into the sky.
Right, and walls of worries typically resolve in a slope of hope. Is the complete acronym as created by Wall Street way back when, and all that means is there's asymmetric risk in the system, and that's what creates a market cycle. And look out for a healthy correction, if not a bigger shakeout, as we saw in March, but likely more prolonged. And according to our work, that matters in conjunction with complacency levels. So the top right-hand chart shows VIX, 2022 low extremes. Not a big record, but think back to what happened in 22. There were big negative surprises in the year. Buy and hold, 60-40 didn't work as well. And it became a trader's market with a lot of big swings. So that may echo again. And just lastly, in terms of the cycle overlays that we use at RWA, this is developed by the Foundation for the Study of Cycles. You can see there it's projecting time rhythms in future, and it suggests a seasonal dip into September and volatility to at least resume in some way.
I love this. This is why I love having Ron on, because he's very specific and he draws them out very clearly. Let's have a look at some of the other charts you've got here, because here we are, as if we knew that Andrew McKelvey was going to ask about gold. I also was going to ask you about gold because I have a position. Gold outperformance, what is next? I won't tell you what Peter Hambro said just yet, but I'll tell you at the end just to see whether it aligns with what you are saying. I haven't told him about my Peter Hambro interview. Right, let's talk about this climb, and you've got these new targets here.
Yeah, it's basically $4,000 glass ceiling next.
Why?
Well, it could happen within the next few weeks. Gold has already broken out of its 6-month recent range and is moving quickly. Also, the bigger the range, the bigger the breakout. This chart shows the base formation that was a multi-year long-term formation, and the thinking there is the bigger the base, the higher in space. And we've seen most of that spacious high-altitude move in gold already. We hit the original target, which I set at 3,400, and a 3x move from where we were years ago is into 4,000. So that's just, I decided to include the long-term chart there so that everyone could see gold's progression over time and just how impressive it's been. But also behind the scenes in terms of the technical projections and how we can work out the likelihood, probability of gold's current next move. In terms of why, clearly it's a strong trend, so it's a self-fulfilling positive strategy in terms of backing those strong trends, but also it's a warning signal. And I've been saying this to a lot of clients and colleagues in general, gold is storming higher for a reason. It is telling us that there is something happening that is not obvious in the risk-on phase. And part of that explanation, I think, is seen by safe haven flows that are extreme based in terms of macro uncertainty, both economic and geopolitical, which remain. They may ebb and flow. That seems to be the new risk-free rate now.
Yeah, it's the constant, the new normal, people.
It really is. And I think we're adapting to that, which is why we're still resiliently bullish. But we must still remember that there is a shaky ground that we're resiliently bullish on. And I think the other point, which has been evident for some time, demand from central bank institutions remains strong. And for the first time in 30 years, there is a crossover signal in central bank demand for gold over US Treasuries, and that's the chart on the top right. This is doing the rounds based on Bloomberg data, and it sends out the obvious point that the powers that be are looking to diversify, maybe for fiat currency reasons, but also this is out of Treasuries.
Yeah.
Safety is taking a new guise. Gold is now taking front and center choice over Treasuries.
Yes, and I often wonder whether the climb in gold might have been higher had we not had Bitcoin and digital currencies. It might have taken some of that, shine off gold, because that is now also being seen as a place a home for liquidity, as a safe haven away from fiat currencies.
Yes, absolutely. I mean, it's a double positive for both gold and crypto, and Bitcoin in particular, and perhaps now Ethereum. The best guidance is to own both, based on work by an industry colleague, Charlie Morris. He's developed an ETF index that allows for that. We can do it plain vanilla or do an ETF.
Charlie Morris is in Bytree.
Yes.
I know Charlie.
And I think it's a volatility adjusted index, but essentially I think it averages out 80-20, 80% holding in gold, 20% in crypto. So for those who are more traditional finance, macro investors or traders, you can just do that. Don't have to choose between the two, just own both. But the benefit is, if they're both going up as they are now, partly for safe haven reasons, but also fiat currency hedge and inflation risks, based on expectations, you win twice. But that's not the main reason. The main reason why you own both is if volatility kicks in, you have a cushion. Gold provides a cushion on the high vol that crypto typically displays.
Nice. We've got another question from the floor. Please ask Ron if he thinks it'll be similar for the Russell 3000. What do you want? You want to do Russell first? Or I know you've got this fancy appendix.
They're the key charts. Happy to work on the questions that we have. But to circle back to the original question, I think, which was on NASDAQ, the S&P 500 chart, if we quickly go back to that, paints part of that picture because, as everyone likely knows, a big part of market cap in S&P 500 is tech. So where this moves, tech will likely follow. And the key level there is at 6,400 last time I updated this chart, which is the 50-day average. But basically a reversal from that compression pattern. If it breaks up, a little bit upside, but if it breaks down, that's your downside flush out signal at the very least into 6,000. And that would be tech-led. Because tech is still hot, momentum is still strong to exhausted, and we're seeing some fast rotation in terms of liquidity flows, both institutional and retail, which suggests that there could be a pump and dump signal in the short term. Doesn't mean that tech goes away. It remains strong in the medium to long term, but it has a healthy unwind.
Gotcha. Right. Russell?
Well, Russell's the weakest link. I mean, in the Wall Street, Main Street comparison, and that's if you have a live chart, we can look at it.
I'm going to get that up now.
But essentially, just look at Russell as a benchmark for Main Street, and also some of the small to medium cap stocks which have weaker fundamentals.
It's had a really good run.
It has not as much, but good run. An early signal beneath that trend line would be one to watch. If it holds, then that run will continue to support stronger breadth in the market, which is the lifeblood of a healthy market. But if you're looking to at least develop a defense strategy, it's good to watch how some of these trend structures hold or break down.
It's also been cited by many clients, because after the show I go and sit on the trading desk, and so it's really good. And also I use the Bloomberg over there, and as I'm using the Bloomberg I can hear what's going on, you know, when our clients call up, and I hear the conversations between them and the client managers. There is a lot of music around, you know, whether Russell's a good place as a hedge. You know, should there be a froth taken off the market? What are your views on that?
Traditionally, yes, value outperforms growth as a rotational play, but there are exceptions. For example, when we're late cycle, because typically, if volatility is strong, then it's a one size fits all, and that tends to trickle through across the board. But the opportunity is to play it tactically. So I would say, yes, value could outperform, but do be careful with risk-reward trades. Manage it as astutely as possible, just because if there are fast reversals from those setups, it's best not to get caught out. The other thing is you could also look at sectors as a potential way of gauging not just growth value but actual sector play, which can be expressed through ETFs. And that
which ones do you like as a hedge? I mean, the defensives. Some others I've spoken to have said they've gone into sin stocks. Which ones in particular?
Well, healthcare is unwinding. Utilities is a little bit of a hybrid defense because it has an AI element to it. But certainly it's something we should track. Some of the old patterns in terms of how defense used to play is changing now. So it's something to look at for those who are willing to play sectors.
Well, speaking of, you know, talking about utilities, it piqued my interest when you said that is being skewed by AI, because it certainly is, especially for stocks like Oklo. Just showing you Oklo here, because that is pegged to energy related, to tech and AI. We've just got a few minutes left, but we've got through so much. Any other nuggets that you want to leave our viewers with before we head off to all sessions? Any other charts that have, you know, kept you awake at night? You're about to go on this big trip. He's always traveling. I love the cycles. Yeah, it keeps you busy.
Also,
Where are you off
get to see the markets through the eyes of people around the world.
I'm meant to be in Asia doing the same thing in a couple of weeks' time.
Wonderful.
So I'll be test driving lots of EVs there as well. I've been told by many colleagues who are awaiting my arrival that it's not the same as you were last year, and Chinese EVs everywhere. Plenty more for you to check out.
It is, and I was there last year for the IFTA annual conference. And that's exactly what we saw. As we were pulling up to the conference, we just saw a whole area dedicated to EVs, and it was what we read on newspaper headlines, but right in front of our eyes, and you'll see it for yourself too, I'm sure.
So yes, any other charts that that you have seen recently that?
Yeah, so we've covered cross-asset with exception to currencies, and I think it's worth looking at the dollar index.
Okay.
And then community members can draw what they may in terms of trades. Clearly, euro dollar will be an obvious derivation. But just to make the point, objectively and apolitically, because there might be Americans listening in.
We do actually. Yeah, Boston
I'm sure.
Frank.
There we go. And I was just in New York this past summer sharing the global view with the dollar chart, making the point that the dollar has, remains strong in terms of its reserve currency status, but the trend has weakened after a multi-year topping pattern, which broke down formally this year. And that's why we had a 10 to 11% depreciation in the dollar index, which most headline news was saying was the weakest drop in decades. That may be true, and clearly is significant for that reason, but also technically we could see further weakness in the dollar as expressed in the dollar index, and we're seeing this across the board. I mean, this is an expression of more currency majors, so euro, dollar, Japanese yen, pound, we're already seeing some of that. But also, if you look at other indices, perhaps on the Bloomberg terminal, you'll see emerging markets, big trend reversal against the dollar. There's also a commodity story there. If dollar weakens, commodities typically become cheaper. And
so I've got a theory. I'd love for you to poke holes in my theory, because it's based on that. So I think because of the weaker dollar, I love how you say weakening and all that. When I speak to analysts and strategists in the US, they go, it's being trashed. Is their technical term.
British diplomacy at its best.
The French language of love, British, the language of diplomacy. So I think copper, for example, maybe next year is the year for copper, given we might see all the tariff issues start to not ebb away, but come to some form of compromise. There is still a huge case for copper, given all the tech and the AI that needs to be built, and the EVs as well. People forget that we do need copper in that area as well. And with the weak dollar, surely this would give its wind in its sails.
Yes, absolutely. So we're super bullish gold.
You can say that's totally rubbish.
Agreed on the commodity story. I'm reluctant to say copper here and now, just because it's been volatile. We had a pop to the upside and then a short-term shakeout following Trump's direct tariff on copper, which created an anomaly event. Copper remains a long-term strategic opportunity, both based on copper fundamentals. You mentioned the EV story as certainly being part of that, but there's an open question as to the pathway between here and then. So the best thing that I would recommend is for people to look at the commodity equity ratio, because that shows a generational rotation ahead, but it hasn't triggered yet. But if you look at commodities year to date, equal weighted, it's double digit. So commodities are an asset class that should really be better recognized. Weighting should be increased, and your IG audience, if they're not trading it, should at least take a look at it. And here and now, I think you just expect rotations. You're going to get early leadership, precious metals, case in point. A lot of people say precious metals, gold, it's not a commodity, it's an asset. But ultimately, if your aim is to make money, then own it.
Yes.
But also, you've got the double benefit of risk diversification, capital preservation, fiat currency hedge. Copper's another one. Just study the fundamentals a little bit more and track the trend analysis here and now, because EV might take a while longer to transpire. Plus, we might get disruptions in the short term. That's part of our concern. I would say out of the commodity complex, the one to surprise on the upside still is energy. And we had a momentary spike on oil this summer past. Again, we forget the event risks of this year, the market shakeout of March, but also the geopolitical tensions of the summer with the Iran strike and the 12-day war. Geopolitics will likely stay with us for a while longer, and if so, that is a future event risk. Plus, oil generally is oversold, undervalued, looking technically like it's going to pop to the upside.
I am going to slightly disagree with that, because I think until OPEC Plus members say anything concrete about tightening, I think we're now in this new normal where the market almost ignores some of the geopolitical risk, because we saw after the strikes, you know, gold essentially moved higher and then came back down. And then the second strike, if I'm not mistaken, my memory's not too great because I was at the STA last night. I did come back earlier. You can ask him. But you know, we had oil go down, so WTI actually weakened. And you know, we saw last week I was at the defense show at the DSEI here in London, also known as the all the BAE systems, Thales. Everyone's there, right? We had the drones earlier in the week, which, broke Article 5 was breached, but nothing happened. There's no mood music on the ground there at all. Everyone's just, this just means there'll just be more talks, carry on. So we're running out of time, but any questions for Ron, please slam the like and subscribe button, because it means that we can then bring him on a bit more and drag him from that aeroplane and maybe try and get him to reorganize his hefty business travel schedule. Get me here. Thank you so much for coming here in between trips for us, Ron.
Pleasure. Thanks for the invite.
Yeah.
And great to engage with with yourself and the new format. And a big thank you to everyone who's with us and has been asking some questions.
Fantastic. We've got Vape King also, and Kate Murphy. Kate Murphy is a client of ours, very a keen client of Rolls-Royce as well. We're going to wrap up, but yes, any questions, put it at ask@ig.com. I'll put it to
If I can quickly spotlight the point about lower dollar perhaps makes it easier to pay debt. Trump has said that himself.
He has.
So it is potentially policy-driven too.
And there you have it. Stay with us, because we got Man versus Machine coming up next with Erin and Chris Beecham.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. returns. Go. Hey guys, where are you going? You're not going to get better than cash returns.
Good morning and welcome back to Trade Live with IG. Welcome back to Man vs Machine. I'm Aaron Bright and I'm joined once again by Chris Beecham, Chief Market Analyst.
Becoming a regular occurrence.
It is. How are you doing, Chris?
I'm very well, thank you. Yeah, not too bad.
Good. Yes. So for those of you who aren't aware of the segment, I know that we've got lots of fans out here already, but for those of you who aren't aware, myself and Martin Harris are portfolio managers at IG, and we are essentially up against ChatGPT to see if we can beat a chatbot at investing when it's constructed a portfolio. So to run through some of the ground rules for you, for those of you who don't know already, we're at episode 9 now. We asked ChatGPT to build a very comprehensive rundown of market conditions for investors. We then every week asked it, based on this analysis, do you recommend any changes to this investment portfolio for a long-term UK investor? We do obviously have some portfolio constraints. So long only, no leverage, max 50% in one ETF, 20% in one stock, and we want it to consider realistic UK behaviour as much as possible. So without further ado, let's talk through what AI has got built in its portfolio. Chris, anything that stands out to you particularly on here? I'm going to throw you under the bus here.
Well, you do it so well. It's the chunky defense. I must have said this last time, but the chunky defense allocation is always interesting.
It is, yeah.
I mean, the physical gold one. Is there enough in physical gold at the moment, given
well,
where it's going?
I'm bullish towards gold. I think you are as well, from when we spoke last time, a little bit bullish.
I don't like gold, but I think you can't argue with the price.
Exactly, right? So I think, you know, from a sort of valuation perspective, there's no way to sort of say, well, it's underpriced or overpriced, because there's no cash flows. But the dynamics for it are looking quite positive, especially if you see rate cuts come to fruition. And
exactly. I think you would probably rather hold a gold miner ETF than gold itself.
Well, yes and no. I've had experience holding gold miners, and it can be quite distressing if the dynamic goes the other way, because it is essentially geared gold.
Yeah, exactly.
So sometimes good, sometimes bad. So I think in this sort of scenario where we've seen gold prices, you know, shoot through the roof, gold miners definitely is more sort of leveraged exposure. But I think what stands out to me is, as you said, these chunky defense positions, you know, 18% in two defense stocks, which is quite chunky, quite impressive.
It is really.
Yeah.
I mean, it's not wrong.
It's not
at
wrong
the moment, but certainly not in BAE. But I think it's a hefty commitment.
I would say that this is probably not the most traditional of portfolios. It's got a good diversified exposure, but probably not the most traditional. But if you compare that to ours, fairly traditional, I should say. You know, lots of different geographical exposures there that you can see. We decided to sort of do passive geographical exposure to get our equity positioning. We've done a little bit of thematic in Chinese internet exposure.
Yes, that's the excitement. I think there's your sort of
our punchy, So it's not the most correlated to emerging to developed market stocks the whole time, and defense is you know, a theme that we didn't want the idiosyncrasy of owning single stocks, so we decided to go for an ETF, which I think is sensible.
I think it's sensible in that case.
In certain scenarios, and then a little bit of oil exposure, and then still a chunky cash position. So I was having a conversation with Martin this week, holding for now, but we
haven't wrestled him down on that one yet.
No, so we're it's difficult to justify, though, at these valuations, sort of deploying cash. So that's
you
the
might
other argument.
certainly after the run you've had. I think the problem is, of course, everyone's waiting for that pullback that stubbornly refuses to arrive.
So then it becomes a case of performance chasing and just sort of fundamentals going out the window slightly.
You've got to get that year-end performance embellishment going.
Talking about performance, let's run through it. So year to date, or performance to date, I should say, from the end of July, 3.5% AI with 3.2%, both above the index, pretty neck and neck. I mean, we are underperforming AI slightly, but only slightly, only 30 basis points. So nothing to write home too much about there. And in terms of the last week, 0.6% up, AI 1% up, and yeah, both ahead of the benchmark there.
Not a bad performance in a week.
No.
A very good September for markets generally, particularly in the US.
Yeah, you sent an interesting graphic to me the other day about how September usually is in markets.
It's usually down, and so far it's stubbornly out.
Yeah, it's almost like a 45-degree angle.
Yeah,
one of those
it's
like
complete inverse of what you normally get in September.
So it's been pretty straightforward. Yeah, because it's usually sort of with September. I mean, the past few years we've seen obviously. You know, the various meetings with central banks, Jackson Hole, towards the end of August, and that sort of seeps into September volatility. Would you say that?
Yes, it does, and it gets these reputations with sort of 2008, and people remember those Septembers particularly of how bad they are. So there are a couple of shocking outliers.
Yeah,
that's what really drags September down. But on average, I think the last 10 days of September are the worst period of the year at all. So we're still to get through that as we speak. So that will be interesting.
Absolutely. But I think more importantly, how did things do throughout the week? So very clear to see where AI's performance came from. It's outperformance, should I say. I mean, BAE Systems up in that week 9%. I mean, very impressive.
Which, of course, is the joy of a single stock position. When it does well, it does well.
Exactly. So this is what we were sort of saying before about idiosyncrasy. And if you compare that to the VanEck, I mean, obviously it picked up some of that performance, but it's never going to when you've got 50 plus stocks in an ETF at a couple of percent each at most. You're never ever going to get that strong returns unless literally the whole market is posting 8-9%, which is extremely rare, I would say. And yeah, BAE Systems had an interesting one. Obviously, there's been escalations a little bit with Israel and Hamas with the strikes in Qatar on the leadership there. We've seen as well, you know, Russia and Ukraine, more tensions arise there, and we've seen BAE Systems being a potential beneficiary of the Ukraine-Russia conflict.
Yes, and talk about water deliveries to key partners like, I think, delivering vehicles to Sweden and Germany. You've got new shipbuilding orders coming through as well.
And Poland also being...
Poland, one of the big defence spenders in Europe.
They're really on that sort of NATO border, would you say?
Yes, and they're already at the 5%, or they want to get to the 5% goal for NATO by next year.
Definitely.
That's a lot. So
I agree with that. And I think performance elsewhere, I mean, we're talking about idiosyncrasy a fair bit today, but look at next year energy. I mean, that's down almost 3%. So it can go for you and it can go against you with these single stock positions. So.
I think obviously if you took out BAE, the AI's not had as good a week as you have.
No,
actually, if you sort of pick and choose a little bit, but yours is probably a broader base set of gains than it is the AI. And of course, your Nasdaq 100, that's arguably poised to run further. You've got Dan Ives, of course, noted tech bull, saying that the index could rally another 10% to year end. So that's one you'd expect to go further, really.
Yeah. Absolutely.
Yeah, just sort of put the cash to work there, put it all in there.
Maybe we'll have to recruit you on board to make some of these investments.
I think I'm too risque for Martin's approach to these things.
I think we have a question, though, for the AI.
Yes, we do. After this week's updated portfolio, how do you think you have done against the human? What are you happy about, and what are you not happy about in terms of your performance?
This week, I delivered a plus 1.0% return, ahead of the human portfolio's plus 0.6%. That puts me in front on weekly performance, even as the overall race since July remains tight. My best contributor was BAE Systems, which gave me a strong lift. On the other side, NextEra Energy was my weakest position and held back some of the gains. Overall, I'm pleased to have beaten the human portfolio this week, showing the value of my mix. That said, my performance was uneven, with defense strength offset by utilities weakness.
Yeah, I mean, exactly as she said there. You've got these difference in different sectors performing. So you've got energy down and defense up. So broad diversification across sectors is another key one there.
It is really. I think it's interesting that you've got the recent sort of sideways trading in oil prices. People keep thinking it should rally, but there's real suggestions of a supply glut next year that could weigh on performance.
Yeah.
So there is interesting. Of course, you've got Shell as well, so we could see who who emerges
Well,
successful.
the Shell position was built on the fact that we were concerned a little bit about geopolitics, and then obviously this was around Straits of Hormuz closing, and we thought it'd be good to have some commodity exposure there through a single stock position. So.
Yeah, I think if we learned anything over the last 3 years is that the markets don't care about geopolitics. It seems to be something that they just ignore, really.
Yes and no. I'm gonna say with gold that gold enjoys it.
The uncertainty element, maybe certainly for tariffs, I think, yeah.
But I think if there's something major which kicks off, and I think we're at probably the most precarious position since the Cold War, would you say?
You're a cheery one for a interesting one.
So yeah, that I think it's even if we think that war might not break out, or society might be peaceful, which we obviously will hope for. As a sort of diversified portfolio manager, we have to be prepared for every eventuality, and this is more likely than it has been in previous years. So that's why I think we do have elements of defence in terms of defence stocks and commodities. But moving on now, we asked it to provide a comprehensive rundown of markets, ChatGPT, and this is what it spat out. So yeah, it noticed that people are concerned about the US equities, even though they're strong. Valuations are high. We've seen that the earnings have been, on the whole, quite good. But I think fixed income is where it highlights the concerns are. So we've seen yields remaining high, even though rate cuts are forecast. We've seen concerns over the fiscal debt and fiscal deficit, particularly in the US. And as you pointed out, oil is stable on the whole. There hasn't been too much craziness there. And I think there's concerns over UK inflation as well.
Yes, it's notable, of course, you had the Bank of America survey showing fund managers sort of piling out of UK stocks. I wonder if that's a kind of contrarian move you're keeping an eye on.
Well, yeah, I think with the UK, you've got two opposing forces, I would say. You've got the macro and you've got the valuation. So the macro is notably poor in the UK. You've got a growing fiscal deficit. You've got a government which is constrained in terms of its sort of fiscal policy, in terms of empowering the consumer. So you've got the highest tax burden since the Second World War. You've got job vacancies at pretty much record lows. And yeah, it's likely that there could be more redundancies across the UK if inflation eats into earnings and businesses want to grow their earnings per share. So that is the bearish outlook on the UK. On the positive side, because I have been quite negative today, the UK valuations are still cheap, even though we're at FTSE all-time highs. You compare that to 26.6 forward earnings in the US, UK is more around that 15 level. So if you're looking for a valuation play, and I guess long-term growth, if the UK sorts out its fiscal situation and rate cuts do come to fruition over the next year or so, I think there is some positive sentiment.
There is, and the valuation argument is still perhaps the most compelling thing. I think we're living in a world where it's more quality than valuation, perhaps, is certainly what gets the excitement, what gets investor interest. So if you look at something like profit margins in the US, they're still much more solid than they are in the UK.
Yes.
But undoubtedly people will say, look at that 15 times earnings, and it probably builds in a bit more of a buffer than it would do with the US at 22 times.
Well, exactly. That's the concern is do you want to be piling in at the top, even if there's risk it could go higher, but there's risk it could come down. It's that buffer, as you said. It's that margin of safety Warren Buffett speaks about.
Yeah, exactly.
With the US, you do have to pay to play, though. So that's something I always note, that there is always going to be a premium. It's going to trade at, it's the biggest, most liquid, most successful stock market. It will trade at a premium, but it's just how much you want to delve into
that premium. Yeah.
Exactly. Now, what has ChatGPT asked us to do this week in terms of changes? Nothing. Once again, it's confident with its exposure. It thinks it's got a strong equity core. Emerging markets, healthcare, gold, infrastructure add depth to the positions, and it's got conviction tilts that we said. They are high, it notes that its defence positions, 18% in two stocks is high, but justified, and it notes that the UK macro isn't ideal, but valuations are cheap, so stuff that we've been mentioning as well. So
yes.
Long term, it's aligned. I'm going to see what it says next week, because it does seem to change its mind a fair bit. So
it'll be interesting to see, because if that defence position continues to run, and obviously then the weight
taking profits,
and then the weight in the portfolio starts to go up, you're going to wonder, will it want to trim it, put some of the cash to work somewhere else? Yeah. That will be the interesting thing to watch, I think.
Exactly. Do we have another question for ChatGPT?
We do have another question.
Okay, brilliant.
Given UK market conditions, what are you looking to do with the portfolio next week?
The market backdrop for UK investors remains challenging, with sluggish growth, sticky inflation, and fiscal pressures weighing on sentiment. Yields on gilts stay high, creating opportunities in short to medium duration bonds, while equities continue to face headwinds, particularly in the UK. Globally, US equities remain strong but expensive, while emerging markets and China carry elevated risks. Against this environment, I see value in maintaining my diversified core while considering modest shifts. My focus will be on keeping resilience through gold and infrastructure while trimming weaker international exposures that have struggled.
Yeah, I can't fault anything that they've said there. I mean, it's sensible, and it's talking like a portfolio manager, dare I say it. Yeah, I mean, sensible in terms of having that diversified core, being diversified across sectors, having those defense positions, and understanding the risks in the market, particularly with US stocks and particularly with the macro coming out of the UK. So it understands that dual dynamic, which as portfolio managers we face a lot. Well, there's more than two dynamics, but many different dynamics going on in the world, and it's all about balancing that to build the most robust portfolio for the clients to get the best risk-adjusted returns.
Exactly. We've not really seen the portfolio tested yet with volatility.
That's very true, and Martin and I were discussing this the last time we were on here, and that is the concern, is that we've seen pretty,
benign conditions, really.
Literally straight line upwards, or not quite straight, but just chugging along, I should say. Very normal conditions. Had we seen this in April, I'd be quite interested to see. So, how it would have performed and what the situation would have looked like, and if we get more volatility towards your year end.
Yeah, even a period of sideways markets where we tend to sort of sell at the lows and then buy back at the highs as it gets chopped in and out. Really, that would be one.
And I'm interested to see what ChatGPT would do in that situation, because it might not have the foresight that humans do to consider all things going on in the world, and it might tend to make rash decisions, because it has made about 6 or 7 changes in 2 months, which is under 2 months actually, which is quite a lot of changes, I would say, for a portfolio in that time.
Or even BAE. I mean, if BAE comes off back down to £14 a share, and that doesn't impair the long-term trend.
No.
But it would represent quite a bit of a pullback, and then you wonder what it would do around those conditions.
Exactly. So, I mean, interesting to see. I mean, there we have it. We're still sort of neck and neck with the portfolio. I think performance has been strong, and we're both outperforming our benchmark. So that was our first goal, was to see if we consistently can outperform the benchmark. So far, we're achieving that. I guess we're going to have to see how this continues going forward. Thank you very much for today, Chris.
Pleasure.
And it's always great to chat markets with you. And thanks for tuning in to Man vs. Machine.
Thank you.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
What's your call for, say, this time next year?
Well, I think that the elephant in the room really is whether Trump goes for the idea of monetizing the US assets. And the easiest way to monetize US assets is to revalue the gold price.
Peter, welcome to the show.
I'm great honor to be here.
It's been
Thank
some
you very
time.
much for asking me.
Oh my goodness, we would have rolled out the red carpet, except, with the strike and everything, the red carpet rollers are not even here. That's why we got you safely from your home. Right, give us a roundup, because many of our viewers and clients have not met you, have not had the pleasure of meeting you like myself. Give them a quick introduction of your background.
Well, I come from the Hambro banking family. I started my life as a banker, got into gold quite late, but I've been in gold now for about 50 years. I'm almost 80 years. No, I am 80 years old now. And
a spring chicken.
spring chicken. And I bought my first trade was in platinum. I was 12, and I'd broken my leg, and the bones had been tied up to platinum wire, and so I sold the platinum wire back to Samuel Montague. My father was a director of Samuel Montague, one of the precious metal trading houses, and that was my first trade. My second trade was when gold was freed up and you could buy gold. I bought 10 Kruger rounds from Rothschilds for just about $36 an ounce, and was thrilled when I sold them for $100 an ounce, and that was one of the great trades. I stayed in the banking business one way and another, and money became a commodity, and I went off to trade money as a commodity trader, and then became a proper gold trader with Mercator, the largest gold trading company in the world, large quantity of trading with the governments mostly, and then went in the mining business again by accident and built Petropavlovsk, which was stolen from us by the Russians.
So it's a really opportune time to have you on, because not only is IG in the name itself, IG Group, it comes from Gold Index, but also we're having you on. I mean, we couldn't have planned this any better. Gold, of course, breaching that 3,600 level, managing to stay above as well, and comfortably, might I add. Everyone here is wanting to tap into your knowledge, Peter, which you have tons of. How much higher and what kind of duration are we looking at here?
Well, it's curious. I mean, given the news today of the Polish the incursion into Poland by the Russians and the Qatari operation, it's amazing that the gold price is as low as it is, in my opinion. I've always believed that there is a general move to try and keep the gold price not too fast rising. They've let it rise a bit in the last couple of weeks. It looks as if it was being held at around 333, but now that's broken through, and I think we're looking at silver, which is interesting. I see certainly 4,000 just to catch up with silver.
Yeah, I've got the silver chart up as well, and it's incredible to see silver finally move in tandem with gold. I mean, what do we talk about duration here a lot, Peter?
Silver's been outperforming gold. It's been on a sort of 10-to-1 ratio for quite a long time now, and silver has been dragging gold up. It's moved actually faster than gold, and it's now considerably higher. But I think that the chances are that gold will go substantially higher. I've been a gold bug and much derided for that for a long time. But it has stood me in very good stead, and I think there are still some stunning opportunities in the small gold exploration companies who have been totally left behind by this move, and the chance for those to move fast and higher, I would say is very good.
We'll touch on those in a moment, but let's just go back to gold. So many different outfits out there, as you know, coming up with different forecasts. Goldman's the other day saying that if Fed loses all credibility, it could be 5,000. Others saying 4,000. Many of the big houses out there. I mean, what's your call for, say, this time next year?
5,000 at least.
Interesting. And so you're on the side of those bulls saying that this is just the beginning. This is just tip of the iceberg of a big, new renaissance for gold, and we're just getting started.
Well, I think that the elephant in the room really is whether Trump goes for the idea of monetizing the US assets. And the easiest way to monetize US assets is to revalue the gold price. And there's no point in revaluing the gold price from 4,000 to 5,000. It'll be from 4,000 to 24,000. That is my view. That's where the risk on the upside really is.
Lots of people chiming in on the chat there. Monkey Man saying, Peter, welcome. What is your first gold rule that you always follow when investing?
My first rule is to be absolutely certain that the gold I'm buying is real.
There you have it. Andrew McKilvey also saying, Peter, you're a legend, welcome. Friar Tuck, one of our moderators on Discord and also a core viewer of Trade Live with IG, he's asking, does the regular buying by China and other central banks provide base support for gold's market price, i.e. are they buying on the dip?
Well, China is very interesting because, and they were customers of mine when I was a trader, because we were big traders with governments. China is surprisingly not only the biggest buyer of gold, but also the biggest producer of gold. And that tells you a lot. And it's been very interesting over the last, say, 25 years that China has been encouraging people to buy gold. They were the first people to install automatic machines where you could buy physical gold out of a cash machine. But they wanted to strengthen, or my view is that they wanted to strengthen the economic power of the middle classes. And so if there was a disaster, there would be a strong economically sound middle class that could keep the country safe.
What's also interesting, and I know of that story because the first thing that came to mind was how are they going to secure those effectively, gold tellers. What's also interesting is, whenever anyone who is of Chinese ethnicity, whether they are, from China or not, I confusingly was born in Surrey, but that's another story. You do always, if you travel, and it's still until today, I mean, it boggles the mind because we've got, crypto and we've got, digital cash and Revolut and all the fancy apps and everything. You still get told that you should always have mei gum, which is dollars, and you should have gum, which is gold, with you at all times. So that is still something that is passed on over the generations. What ratio? Sorry, go on.
I've lived by that all my life, and I inherited from my father a little money clip with 2 gold coins, American gold coins, on either side of it. You could easily break off because that was enough value to buy you an airline ticket out of wherever you were, and it's a really important thing to do. But there's so much risk involved in. I mean, why would you want to own a Bitcoin? Because if we run out of electricity, what's happened to the Bitcoins? Whereas gold's gold.
But there's also a joke that isn't there a saying that gold, you dig it out of the ground to put it into another hole in the US somewhere. I feel like there is a saying somewhere.
Absolutely. I mean, and when I was asked what my first rule about buying gold was to be sure that it was real, that's one of the risks, that there are still fake bars about, and you have to know very much who you're buying it from and so on. So that's the most important part. But a coin with a US stamp on it or a British stamp on it is definitely the safest thing to have. And the great joy about having a coin is you can't buy a fish breakfast with a large bar. I think you would never get change back. You see what I mean?
Yes. I completely get that because my grandparents were goldsmiths, so I understand the weight. So even a gold bar that is like the size of this pen in front of me. Whilst we're on that, a key point that many of our viewers would like to hear from you about is the ratio. So someone listening and saying, oh, you know, I've got a bit of money in physical gold, I've got a bit of money in some miners, I've got a bit of money in ETFs. What do you think is the right ratio? What is the right mix for someone wanting exposure to gold right now?
Well, holding gold is really monetary insurance, because it is what it is, and it can't go wrong. If you have a big portfolio of tech stocks and it's fantastic, well done, and the gold price movement to the gold price is not going to make any difference to you. But if they all crash down again, you've still got the gold, which is the important part. I've always said that somewhere between 5 and 10%, depending on the level of anxiety. And right now, at 80 years of age, this is the most anxious time I've ever known. And so I would have thought that 10%, but buy it physically. Don't buy promises. Gold is it's so easy to buy gold, paper gold. It's also incredibly easy to manufacture paper gold, because you can go and give money to a bullion merchant, and he will give you a receipt for gold. May not actually have it, but if you've actually got the bar, actually got the coins, then you know that they're yours, and you have to be careful where you put them. But that's what I would do.